Equifax is pleased to welcome you to today's webinar, the Q3 U.S. Economic and Credit Trends Outlook. My name is Teresa Fries, Senior Director of Portfolio Marketing at Equifax and your host for today's webinar. On behalf of the entire team at Equifax, I want to thank you all for attending today. Our goal for this webinar series is to deliver timely insights on the economy and key trends in consumer credit that can help drive strategic growth at your organization. Whether you're looking to benchmark your company against the national market, better forecast your book of business, or monitor shifts in the economy and industry in general, we're sure you'll find value in the insights delivered today. Please note that today's call is being recorded and all participants will be muted during this broadcast. This presentation is scheduled to last 1 hour and will include question and answer opportunities at the end of the call. You may submit a question at any time by typing it into the chat box in the lower left corner of your screen and clicking the send button. The webinar will be available for replay and you'll receive a follow-up email with a link to the recording within 24 hours. Over the next hour, this webinar will include an overview of the U.S. economy, an update on consensus forecasts, and a look at interest rates, the Fed and macro trends impacting the U.S. We'll also cover U.S. consumer credit trends, covering the consumer debt outstanding by source. And our special report this quarter is the portfolio performance and credit tightening, where we will do a deep dive on portfolio performance and the recent tightening that's occurred in response. In particular, we will look at bank cards, auto lending, and HELOCs, segmenting by lender type. Each quarter, we will present on a different topic in our special report section. Future quarters may focus more closely on mortgage, fraud, student lending, or other key topics of importance to our customers. In fact, at the end of today's webinar, you'll have an opportunity to suggest a topic for upcoming webinars. We do encourage you to take a moment to share your recommendations at that time. At this time, it is my pleasure to introduce today's speakers. Our first presenter is Amy Cruz-Cutts, Senior Vice President and Chief Economist at Equifax. Amy is a recognized industry expert with over 23 years of economic analysis and policy development experience. As Equifax Chief Economist, she is responsible for analytics and research relating to the consumer wallet, assets, income, credit, and spending, along with macroeconomic factors affecting the consumer. Amy is also responsible for macroeconomic forecasting and the economic analysis of employment and wage trends, home equity and real property, and small business credit trends. Also joining us for the first time this quarter is Gunnar Blix. Gunnar is Deputy Chief Economist at Equifax. Before assuming his current role, Gunnar led customer analytics for the Equifax mortgage vertical. Prior to joining Equifax, he was a senior research analyst performing analysis around modeling mortgage prepayment and default risk, creation of a short-term prepayment scoring system for marketing applications, and custom property and mortgage analytics for academic research. In previous roles, he provided consulting and customer relationship management modeling in the banking, insurance, telecommunications, and travel verticals. And with that, I will turn the presentation over to Amy and Gunnar. Amy?
Thank you so much, Teresa. I've been watching you all logging in here, and it's great to see so many friends and associates that we've met over the years joining in, and thank you so much for your time today. We've got an ambitious agenda, a lot of cool things to do. I'm going to start off with highlights from an economic perspective, macroeconomic perspective, and then we'll dig into some credit trends, things that we've been watching, in part in response to things that have come across the news, things that the Federal Reserve Board or that the New York Fed has released that have gotten quite a bit of attention, and then also walking you through some of the things that we've said recently that have gotten quite a bit of attention, some of it perhaps a little scarier in the headlines than we intended. So we'll walk you through that. All right, first thing I wanted to start with is that U.S. economic growth, as has happened now for the last 7 years, we've had pretty slow growth in the first quarter. That is set to accelerate. The expectation is that when we get the first read on Q2 GDP growth, that it will be in the 2% to 2.5% range, an improvement over the first quarter. But even with the first quarter lower than expected growth pattern, we still expect this year to outpace 2016. What I've shown you here in the slide is results from the Wall Street Journal survey of leading economists. If you don't have an economist on staff, I think it's a nice source for major economic forecasts, and you don't have to go dig it up from all the websites yourself, so it's a nice synopsis, although many other economists have more detail in their personal forecasts. Unemployment is still going down. I'm going to walk you through some labor market dynamics that may help to put some color around, even though we have unemployment falling and certainly employment rising, and the wages have started to go up. They haven't been going up that much, and the pressure isn't there, and I'll show you some of the reasons why I think that's true. Lastly, crude oil prices are important because of the impact on the consumer wallet. Oil prices came back a little bit. They've been steady pretty much right around under $50 for a while now. Forecasts looking out over the next couple of years, again from the Wall Street Journal, highlight that expectations are that they're not going to go much higher, maybe staying below $55 a barrel for an extended period. There's a lot of American production that once you get over $50 a barrel becomes viable, and certainly as you climb closer to 60, even more of it becomes viable. So this is kind of a weak outlook for the energy sector with regards to oil and oil-based products. However, solar and other energy sectors are continuing to do well. It does put pressure, though, even on some of those technologies. That what's the rush to jump in and swap out things maybe for solar or wind when energy prices are low from the fossil fuel side of things? But I think the tide is turning on just overall demand and different technologies for when they do go back up. So I'm pretty bullish on that, other than the oil prices. All right, inflation has been steady and within the Fed's stated 2% bound for a long time. In recent months, it's actually moved down a little bit, which has been a topic of conversation among Fed economists and the Open Market Committee, where they decide what they're going to do with Fed policy. So my expectation and sort of the leading, again, from the Wall Street Journal forecast is that September will be the next Fed raise. It's the next time there's a press conference, so not in August, but in September. And then maybe they'll provide some color around the timing on the portfolio runoff that they anticipate. So we'll find out more about that then. And best guess is that they will start any portfolio reduction in the new year. That's the best guess at this point, but of course, we're all in the same boat of looking towards what the Fed says. In June, as a little present, the Fed gave us the outline of how they're going to unwind the $4 trillion portfolio that they amassed during the quantitative easing, or QE efforts, QE 1, 2, and 3, during which they bought not only Treasury assets, but also Freddie Mac and Fannie Mae and Federal Home Loan Bank bonds and mortgage-backed securities, including Ginnie Mae's. So they really built up this portfolio, really unprecedented intervention in the market. Now the Fed has the job of unwinding that unprecedented intervention, and I don't envy their position. There's no playbook for this, and I think dissertations will be written for the next 50 years over the mistakes that history will prove were made or avoided, hopefully. The first part of this that's important is right now they are topping up the tank. So that over $4 trillion portfolio has remained level because when a Treasury security matures or a mortgage is repaid or amortizes down, they take that money, that principal money they get back, and go out and buy new securities with it. So they've been keeping the levels constant. What they're proposing now is to allow that into runoff. When those principal payments come in, they're going to be decreasing then the level of the portfolio, but they're not actively dissolving the portfolio. That's I think, very important. So this will just mean that somebody else buys those Treasury securities. There's a tremendous amount of demand for U.S. Treasury securities, and I think under this plan, it'll be a little bit of a wait and see how it goes, but I think this plan actually has some pretty good thought behind it, and I think is a nice first step to unwinding that portfolio. So they're going to do $6 billion a month of Treasury securities as the cap. If they don't have that much maturity happening, they won't sell these securities. And in a month where more are repaid than the cap, then they will buy back to that level. Agency securities, so this includes both Fannie Mae and Freddie Mac and Federal Home Loan Bank debt issuance, and then Ginnie Mae, Fannie Mae, and Freddie Mac's mortgage-backed securities. They will do $4 billion a month initially. In both of these cases, they will increase the size of the cap every 3 months by that same amount. So it'll go $4 billion, then $8 billion, and so on. And the proposal right now is that for 12 months, so it'll be a total of 5 increases in the cap. Right now the cap is 0, so the first one counts in that 5. Janet Yellen is, her term is up in February. I was just at a meeting of corporate chief economists, and this was a discussion item, and there's, of course, many thoughts on this. There are many quite capable people who could take her place. Politically, people seem to think that the better answer would be if you leave her in place and things don't go well, you have a scapegoat. If you change things in the middle, then if things don't go well, then it's on the administration for that. So we'll see how it all plays out. I think she's doing a fine job, but it's a job that I would not personally want because I think the stakes are very high. But steady as she goes seems to be her plan, and hopefully history will bear that out. All right, interest rates have come back down. I've plotted out here the 64-year history of the 10-year Treasury along with recessions, and we are still below what had previously been the historical low set all the way back in 1954. And the inset there shows what's happened since 2014. And we were at a low, and it just occurred to me when I was doing this slide in preparation for this that we set a new low last year in 2016. The prior low had been 1.53% back in 2013, and now we're at 224 on the monthly average. Day-to-day variation, of course, much higher than that. But the bump that came up in November seems to have died down a little bit, and we'll see how things play out. Forecasts, of course, always say that the rates are going to go up, mostly because people can't imagine that they would go down further and be sustainable. But history is really no guide since we've had 30 years of rising and 30 some odd years of falling rates. This is my comment about inflation earlier. So on the bottom line in green, I've plotted the Fed funds effective rate. This is the rate that's announced by the Fed Open Market Committee meeting when they meet every 6 weeks, and they set the target rate. And you can see here the raises that have happened this year already. And you see inflation up there. The dotted line is the target rate that the Fed wants to keep inflation near that target but under it. And things got a little exciting there for a while with the core, so that's this Consumer Price Index minus energy and food, got a little bit above that 2% there. And then when energy prices fell, of course, the CPI came down rather rapidly. So this, below trend in below target inflation gives the Fed a little breathing room on what they want to do, and we'll see what they actually do. The next meeting will be in August, in a few days, and then we'll see what they do in September. Okay, this is the portfolio of the Federal Reserve. And the Federal Reserve Bank of New York manages this on the behalf of the Fed organization, broadly speaking. So the agency securities are in red, and the total Treasury security portfolio is in gray. So you really get a sense of how massive this portfolio is. The portfolio over there that we started with, around $750 billion, is what the Fed uses to maintain liquidity in Treasuries, as well as to enact any market changes. So whether they raise or lower the target rate, then they actively intervene in the market. So you can see that we have a long way to go. I did the wind down not forecasting that they start in January, but I needed a start date, and January seemed like a pretty good one. So if they were to start in January, according to the maximum cap plan that they announced, this is how fast the portfolio would run down. So it takes us about 5 years to get back to about the total level that we were at before 2007. But this, at least in this path that they've announced, would still have a sizable mortgage-backed security portfolio, which is it'll be interesting to see if they plan to keep that going or if they will get rid of the mortgage-backed securities altogether and go just Treasury. All right. In terms of labor markets, I mentioned earlier that I think there's still a lot of strength in the labor markets, that we have continued hiring at pretty good rates. It should decline over time as we get closer and closer to whatever full employment means. Unemployment rate continues to fall, but it doesn't feel like a very strong economy from the labor market perspective, and part of that is wages are not rising as rapidly as you would think in a near full employment environment. And so this looks at population numbers a little more closely. So employed to unemployed, the numbers there match up pretty nicely with where we were prior to the recession at the prior peak, but not as good as we were doing prior to the 2001 recession. But with respect to employment to population, we don't have as many people employed relative to the size of our population as we had even during the prior recession, the 2001 recession, which was not only a recession in which there were jobs lost initially, but that continued on for 2 more years after the end of the recession. So it was a job loss recovery, kind of an interesting economic phenomenon there. But so we still have a long way to go with the employment to population ratio, and I think that's part of why wages are relatively subdued. So the unemployment rate only measures those people looking for jobs. This ratio is kind of looking at a little bit of slackness in the market, and what happens is as the job market appears to be tighter, the unemployment rate falls. People think, wow, getting a job is going to be a lot easier. They go from being not in the job market, not in the labor force, to joining the labor force, and so I think that's part of what's keeping these numbers down, is the low participation rate. In terms of demographics, what I've mapped out here is the total size of the U.S. population in millions by age group, looking at 19 to 21-year-olds, and then 63 to 65-year-olds. So millennials entering the market today. The youngest millennials are 16, so we're just turning 16, and we're now looking at those people just entering full retirement age, 63 to 65. And I started this back in 65 because that's when boomers first turned 20. The leading boomers first turned 20. And you can see here that we're now getting to a point where previously we had lots of young people filling in for the older folks, and now what we've got is a situation where we're almost getting not quite, but almost a one-for-one replacement on people of retirement age versus young people entering the market. So the peak on both of these is kind of happening right now, and after that it's kind of all downhill from there. So growing the labor market really would depend on 2 things. One is immigration. It has long filled some of that as our birth rates have declined. And the second thing is older people working longer. And that's in addition to the overall participation rate. So in this slide, I looked at the share of each age group that's employed. So this is kind of like that population to employed ratio that I showed earlier. And you really can see here that in 2015, 2017, that the share of people 65 and older working is growing. Now we're up to 19%. That's a record over this time period for older people to be working. And we're climbing back up, but we're not yet at the peak for younger people to be working. And again, climbing for those 55 to 64-year-olds. All right. Now I'm going to move into credit trends. Anytime you see a slide that looks like this one that has that red box up in the corner, this one says U.S. consumer debt, that's a slide taken directly out of our monthly credit trends reports. If you are not already receiving these reports, please contact your Equifax salesperson to get on the distribution for these. And in the news recently was that consumer debt has hit an all-time record, and absolutely that's true. We're now at $12.8 trillion of U.S. consumer debt, up from the 12.75 that was set in mid-2008 before the world ended as we know it in September of that year. So that's when Lehman Brothers and a bunch of others failed. So importantly, two critical things here are not included. One is that this is the nominal level, so we don't take out inflation, and I think that's pretty critical. Even though inflation has been relatively low over this period, it's still 2-3% per year, and when you have that, that certainly erodes at that. So on in real basis, the share of it that it takes out of our paychecks is a little bit less. The second part that's important is that the population is larger over this period, so per capita the burden is actually lower. But the news media made a big splash about this, about setting a new record for total debt, and so I don't think this is a huge issue on its face. Looking at the sources of that debt, though, it's changed a lot relative to what we had prior to the Great Recession and the financial crisis. So first off, mortgage debt, this includes home equity as well as first mortgage lines and loans, down $1 trillion from where we were prior to the Great Recession. So that's a huge change in total mortgage debt outstanding. Non-mortgage debt has grown by over $1 trillion, and the makeup of that non-mortgage debt has also changed. So on the left, revolving accounts includes bank cards and private label credit cards, and then there's some consumer finance, but that's pretty small, that would be revolving as well, is not quite back at the levels that it set prior to the Great Recession, but closing in on those levels. Non-revolving debt, however, is at an all-time high and has been every month. We kind of just keep plodding along and adding to non-revolving debt. The makeup of that is driven by auto loans and leases, which are now at $1.2 trillion. Cars are expensive. People didn't buy a lot of cars during the Great Recession. We literally drove the wheels off of them. In addition, the terms on these, the term length is extending out to 5, 6, and then 7 years, 6 being the sweet spot for term length on most auto loans. Leases are getting shorter to 3 years now. And the cars are holding their value much longer. And I know we hear a lot about used car prices falling, but that's kind of built into the lending sauce. Once you get past the first couple of years, though, these cars are really holding up quite well and lasting a very long time. Student loans, boy, we just keep setting more and more records on that. It looks like it's leveled off in the last couple of months, but these are not seasonally adjusted. So we get big spikes at the beginning of the semester when we get the originations data in for August and September when people had to make tuition payments. Those of course, will rise again. Okay, now I'm going to move on to a deep dive look at bank cards and private label retail cards. The difference is bank cards are the general purpose cards that we buy gas and groceries with and pay for vacations. The private label retail are for use at specific retailers. Okay. This is one where you want to back up a little bit from your computer and kind of get the faraway look. The important thing to me in this is that we had the share of gray, those 3 gray bars at the bottom, rising all the way up through 2015, kind of topped out 2016, and in 2017 we see the gray bars falling down to about 18% now. This is percent of accounts that are subprime. This is with using a VantageScore 3 credit scores. And so this tells me that consumers or retailers, so either consumers asking for credit or retailers issuing that credit, there's been a pullback in the highest risk part of that. And the other part is at the very top is those with no score at all, that they did not have a deep enough credit file to get a VantageScore, and that too has declined. This is year-to-date comparison, so that's a way of seasonally looking at the data. These are reported through June, but originated through April. And then this is another view of it. This is bank card credit limits and billions taken from our credit trends report. And a couple things to me that are worth noting here is that the total number year to date of the credit limits have been rising. They've been rising 5.6%, a big pullback from the rate of increase in credit limits that we saw previous years. So pullback, but not pulling them down. But they still are only 3.3% of new originations. So lenders are being very, very careful in extending bank cards to subprime credit quality consumers. This one is same idea, taking that deep, far back look. But when you look over to the right, the share on the number of accounts, this is again year to date, looking through April, doesn't seem to be as big of a decrease or a pullback in that credit on accounts. Looks like it's fairly stable for private label cards. And now looking at it from the dollar originations of total limits, we see that they actually have year-over-year declined 7.3% for the same period through April, and make up 9.3% of retail card credit limits issued. So rising share of total credit limits, although the total dollars originated are falling. Turns out that when we look at these by accounts, it's also falling. Okay, I want to talk a little bit about the delinquency rates because I know that's on top of mind of everyone's thoughts here. With regard to delinquency rates, we see a little rise in both accounts and balances for bank cards. And this is a pretty small rise, but those of you in the bank card business know that it matters not what it used to be, but where it is today, and every 10 basis points is real money. So this is a pretty big increase for those folks who hold those portfolios, but not as scary as the Great Recession. This is another way to look at it is by credit score, what's happening there. And sort of diving deep, again, the dark bars are the peak of delinquency, comparing more recently, this is June from each year, what's been happening. And we do see a little bit of a rise, really a basis point or so of the 740 and above. But what we're seeing in the higher risk credit scores is a much bigger rise in delinquencies. So, when I think about, is it a mix problem that's causing the rise in delinquencies, that more credit got extended to high-risk borrowers, I don't think would be as much of an issue if that was deliberate in that extension. It's if those borrowers don't perform as we expected them to. And it does look here at least like these lower credit score borrowers are having a little more difficulty with these accounts. Same picture here for retail cards. Here the important distinction is that balances are seeing a rise in delinquency, but again, kind of consistent back to where we were in 2012 after the worst of the recession. But the accounts delinquency rates are back to where they were actually during the Great Recession, maybe even a little higher now. So that's a little more troubling on the accounts and definitely explains the pullback. Here again is this picture by credit score. And again, the high credit score accounts seem to be doing okay, maybe a basis point or two rise. But 720s again showing actually a pretty good rise. And the deep subprime showing a bigger rise. I'm going to walk you through some pictures here, and then Gunar's going to show similar ones for home equity and auto loans. So what's important here is we're going to show you by vintage, by issuer type of the accounts, and then the cumulative non-performance of those 12 months out. And we're going to do this by the credit quality as well, to show you what's happening on origination by credit score. So this is the median Vantage score 3 at origination. The colors, that's going to be on the vertical axis, is the median credit score. Across the bottom is the cumulative non-performance rate. This is defined as accounts ever hitting 60 days late but not curing. So if they hit 60 days and then cure, we didn't count that. But we're really looking here, trying to look at non-payment within the first 12 months. The years, we're going to show you a couple snapshot pictures of this, but you'll see here, we'll show trailing lines that will show you the points on the path along the way. We're going to start off in 2006. So these are loans originated through 2006, and then we'll show each vintage thereafter by year. Then the colors, red is the top 5 issuers of bank cards, the blue is other issuers, and the green is combined credit unions and thrifts. So other issuers would include community bankers as well as non-bank financial companies that issue these cards. If you see an up to the right arrow, it means the expansion prior to the recession. If you see a down arrow, it means the recession, and if you see a sideways arrow, it means we're in the recovery phase post-2009. All right, so this is the picture in 2006. So the other issuers had a delinquency rate of about 17% and represented 22% of the market. The top 5 banks had 75% market share, and their cumulative non-performance rate in the first 12 months of these accounts being open was 9.5%. And you got credit unions hanging over there on the left, about 3% of the market with a delinquency rate also right around 3%, even though they're more aggressive on the credit scores at that time. Fast forward here to 2009, you can see the path there that shows you where we were in 7 and 08. So 2009 is really when the stinky stuff was in full effect in the financial crisis, and the Great Recession was really deep underway. The credit scores first in 2008 went down, then the credit scores came back up on originations, but performance was still pretty bad, reflecting the bad economic conditions. But you see they got much more conservative, and the overall performance of the 2009 book got much better. So here we see that market share by other issuers were actually dominant in the market at that time. Banks pulled back, the big banks pulled back, or big issuers I should say, pulled back, and 46% share and a 13.8%. Delinquency rate notable is that their credit score was, their median credit score on these cards was 736 at that point. Now we move on to 2012, and things were recovering, right? We got more jobs back. We turned the corner on a lot of things. 2012 was good times. We could all breathe a sigh of relief. And you see here that that credit scores came down on the origination book, and the delinquency performance kind of matched that. That we ended up seeing delinquencies rise again. Top 5 issuers took back the top dog position, 49% of the market. Credit score median was 727 for them, with a non-performance rate of 8.1% for these accounts. 2016, so this year would be, for these accounts, would be full year performance for beginning of the year, and not quite, full year performance for the rest. And what we see here again is something that seems, history repeats itself. We've come all the way, full circle, back pretty much to where we started, at least for the other issuers here in this group. The top 5 issuers still a little shy, but getting a little closer on the credit scores, but the performance is much, much better than it had been. And the credit unions and thrifts are actually seeing a little worse performance, about the same credit scores that they were prior. So we came pretty close to full circle. Top 5 issuers back in again with a vengeance. They're 64% of the total market, and 707 is their median credit score, with 6.1% being the cumulative non-performance rate on these new accounts. Okay, with that, I'm going to turn over the driving and speaking duties to Gunnar.
Thank you, Amy, and thanks to all of you for joining us today. I'm going to focus first on what we see in the auto finance market, where we are starting to see a bit of a reversal from what we've discussed earlier in these webinars. Both changes in the entire market for cars, also some concerns around ABS deals are probably leading that development. So this is the origination balance share by lender type from 2016 Q2 compared to 2017 Q2. And we see there that basically there has been a shift in the market share, where the credit unions and captives really gained market share, largely at the expense of the banks, but also a little bit from the monolines. The large banks have pulled back from auto lending in reaction to falling used car prices, which increase losses for their defaults. Banks and captives are, of course, heavily in the new car market, and they compete primarily on rates. So it's natural that the captives will gain whenever the banks are pulling back. More interesting, you also see here, though, that there's a shift gain for the credit unions, which suggests that some of the market is really shifting towards gently used cars instead of new cars when we start seeing a glut of 2 to 3 year old leases hitting the market. And the loss of market share for monolines, which is one of the lower tier lenders, on the other hand, that affects the down market share. And part of this could really be a little bit of dried up ABS financing in response to some of the ABS performance that we've seen lately, and that has gotten a lot of attention in the news. So monolines now are at around 3%, down from 4% last year. Banks pulled back from 40 to 35%, but the top lenders are taking the bigger share. If we look at that in a little bit of a different view, we can look at it by the particular areas that these lenders serve. Credit applicants with good scores, they have many financing options. Banks, captives, and credit unions really competing for the prime borrowers. Both better than 80% of the borrowers for those are really prime. Recall that these really capture 94 to 95% of the total market, so that's really a lot of options for prime borrowers. The only category that's really increased their subprime share over the last year is monolines, that went from 76% subprime to 77% subprime, but recall that that was also with a loss of market share overall, so that subprime market has really been shrinking over the last year. This is another view of the same thing, market overall, but here looking at the percent of accounts rather than the percent of balance at origination. Again, we see that subprime's year-to-date number of accounts, so this is basically through April because we lag, so data through June, but numbers through April because we lag our originations by 2 months to account for the reporting delays. You see a decline in the gray subprime areas, and you also see that the only range with a clear gain is really the 780 plus range, so well into the super prime territory. We also see that same pullback in the outstanding loans and leases. So this is data through June, the first full 2 quarters, and again comparing 2016 Q2 to 2017 Q2. So we see a pullback in subprime balances from 19.4 to 18.8%, so 0.6 percentage point, and we see the same development also on the account side from 20.5% to 20.0%, or a half a percentage point on accounts. I'm going to look a little bit at the performance, how this affects performance. So if we look at this by vintage and by months on book. So these lines are basically comparing all the different quarterly vintages back to 2007, actually back to 2006, because the 2006 were better than the 2007s in some respects. Plotting the months on books of the vintage along the x-axis, and again plotting the cumulative non-performance rate on the y-axis. So basically the ones that go 60 plus and don't cure or go into default. And what you see here, the red lines being the 2007 first to fourth quarters, those are the worst ones on book. The green lines being the 2010 Q1 through Q4, which is really after the financial crisis when lenders had pulled back, that being the best performance on book. And what we see is the blue lines, which is the 2016 and the beginning 2017 orange line, are really looking like they are going to hit right in the middle of the spectrum, similar to the dark gray lines, which is actually the 2015 vintages. So it's kind of a nothing to see here chart. Move along, middle of the road, and 2016 Q4, in fact, looks to be a little bit ahead of the curve, although that's likely because Q4 tends to be when new cars come out or new cars get cleared off the lot. If we focus in a little bit more on the subprime, so the ones with VantageScore credit score less than 620, you see that the cumulative default rates overall go up, but you see the exact same pattern. The red line's up at the top, the green line's down at the bottom, and the blue line's going right in the middle of the spectrum. So really nothing to concern us overall in the subprime spectrum either. I see, so captive here basically are the automakers' captive finance arms. So Ford Motor Credit, Chrysler Motor Credit, CarMax is also included in there. Even though it's a used car lender, they tend to behave more like a captive. If we focus on the deep subprime, that's really where the bodies are buried. So you see the blue lines here, the 2016 vintages, nearly as bad as the 2007 vintages, so the financial crisis vintages. Now, keep two things in mind here. This represents about 4% of the overall market, so this is not a huge portion. And second, it was really not the auto defaults that was driving the financial crisis. So even though they were performing badly, those weren't really the biggest concern. So we are monitoring this very closely. We are concerned about this particular segment, but we don't think it rises to really being a concern for the overall market. Again, it's dominated by the monolines and the dealer finance sector. There's certainly tragedies in that segment, but it's not something that is of concern to the overall market health. Next, we'll put that in action. So the same way here with median VantageScore being the y-axis, cumulative non-performance rate by balance being along the x-axis. And here, dividing it up into banks, captives again, so the auto dealers, financing arms, credit unions, and thrift groups to one. It's really dominated by credit unions, but there are a few thrifts left that look similarly. Independent finance basically being companies that cater not only to auto, but finance in general, so they may actually have cards and auto or so on, whereas monolines only focus on auto and only focus on auto finance. Dealer finance being the last resort for borrowers basically going to the car lot and getting a loan from a lender that is associated with that dealer or dealer chain only. Again, we see in 2006 we were dominated by banks, 44% of the market, very conservative, 678 median credit score, very manageable 1.6 cumulative non-performance rate, with really independents filling out the middle, monolines being more risky than that, and dealer finance being the most risky, but with much, much smaller market shares. Move along to 2009. In response to the crisis, banks and credit unions and captives had pulled back, but notice that monolines and independents and dealer finance are really playing in the same space they've been playing all along, with dealer finance being in the 520s and independents being in the 580s of credit score, and with very similar performance, actually slightly improved but not really all that much improved performance. Still with banks dominating at 42%, now a much more conservative 722 Vantage Score 3.0. 2012, that pullback was still continuing, although now the monolines are picking up a little bit of market share, now up at 3% from 2% earlier. But still with the banks really dominating now in the recovery phase at 703 credit score and 1.5% cumulative non-performance at 12 months. Moving to 2016, monolines then had 4%. Recall that in the last year they pulled back a little bit from that to 2017, but this is really the last vintage where we have a 12-month performance window. So we're almost full circle on this as well, but still slightly more conservative than we were before the crisis. I'm going to finish up with a little bit of a look at the HELOCs. HELOC volume and risk is really at historical lows. We see that originations are slowly growing, both in terms of credit limits, the light blue columns, and in terms of balances, the dark blue columns. But the $40 billion in limits and about $14 billion in balances is still way short of the last peak. So that's in the last quarter, $40 billion and $14 billion in balances. This data also shows that HELOCs are almost exclusively prime, not really budging on that. Median score is in the 770s, and the 10th percentile, which really is a measure of how low lenders are willing to go, is in the 660 and has been hovering there since 2013 and only slightly edged down from the highest level right after the crisis. But before the crisis, it was around 630, so nearly 10% of the HELOCs at that point were subprime. We also see that this is reflected in performance. Severe delinquency rates are falling and continuing to fall, both in terms of balances and in terms of accounts. This is 90 days past due in bankruptcy or foreclosure as percent of balances. The other point is that when we get to the HELOC recast, we are seeing improved handling from all the lenders. We're seeing much more proactive handling of accounts, finding positive solutions and refinancing or finding other options. So for the 2006 vintage, 12 months after recast, so that would basically be into 2017, we saw that 28% were closed positive by that point. And that's really looking from 15 months prior to recast. It's not counting all the way from origination. So very significant portion are being positively handled. And we also see that the delinquency rates are getting better, are improving year by year. A little early for the 2007 yet to see results, but we see that they are on the same trend and perhaps even a better trend of somewhere around 3.7, 3.8% at 4 months after the recast, which is really the critical period. Recast. So recast, to explain that, is really when a HELOC moves from, usually at the 10-year point, moves from being an interest-only loan to being a fully amortizing loan over the next 15 years. And so borrowers will basically see an increase in payment at that point. And it's not really so much due to interest rate changes as it is to moving the loan from a interest only to a fully amortizing loan. We've actually seen lenders back off on that. Many of the new HELOCs don't have an interest only period. They do have a draw period, but will pay fully amortizing amounts over that period as well. To finish this off, we're going to put that in motion in the same way. Again, performance at 12 months, which is really a little early to tell for HELOCs, but should give us an indication of what the risk is and what the performance is. Starting again with the 2006s, here we have done it, divided up a little bit differently in terms of peer groups, which is another thing that we can do with the credit trends data. We can do peer analysis of groups of at least 5 lenders, none of which are dominating. We've divided into national banks, so basically the banks that play on a national scale in the U.S. Super regionals, banks that basically have a large number of branches in a large region, versus credit unions and thrifts again, and then a few international banks that have U.S. subsidiary, and then other banks and financials, which is really more dominated by the community banks. Again, we see that the market share at 64% for the national banks. National banks are really dominating the HELOC market back in 2006. Over the next 3 years, however, the entire market basically pulled back. You see the bubbles have gotten a lot smaller. That's basically the size of their HELOC originations. Almost all of them at this point are below below 10 billion in originations, with other banks, so community banks, basically taking up a lot of that space. Move forward to 2012, we see that they're still playing very conservatively up in the left corner, credit scores high into the super prime categories, and with excellent performance at 12 months. Still the other banks, the community banks, dominating that. And then at 2016, we are now seeing that the volumes of the portfolios are coming back up, but that they're still playing a lot more conservatively than they did back in 2006. And with that, we are going to turn it over to questions.
Yes, thank you, Amy and Gunnar. As a reminder, if you do have questions, go ahead and enter them into the chat panel at the lower left of your screen. Now, we had a few questions that did come through, and we've been addressing one off. Thank you, Amy, for capturing those, and Gunnar for answering the recast question. So we had a couple questions around what the definition of captive and monoline is. I think you guys presented a lot of information today, and were very descriptive, so we had very few questions. You do still have time to submit your questions in that chat panel, and we will address those. But in the meantime, if you do have questions and we don't get to them before we sign off for the day, we will address them in a follow-up email for you. I do want to thank you, Amy and Gunnar, again for your time today, and thank you everyone for your time and for submitting questions. Just a quick heads up that our Q4 webinar will be on November 16th. And you'll receive an email invitation about 1 month prior to the webinar, including registration details. So we do invite you to explore additional assets, additional resources that we have available online, including our new U.S. National Credit Trends Report that's published monthly and available through your Equifax account manager. So reach out to your account manager for a copy of that report. In addition, also available online and updated quarterly is a shorter report with a company Excel file that contains all the chart data from that report. It contains the most timely originations data available, and it's estimated through quarter just ended. It's posted to our Investor Relations website immediately after each earnings report is made public.
Teresa, we have a question that's come in
Yes, ma'am. Go ahead, Amy.
So the question is, do we have a breakdown on which delinquencies are true credit risk versus first-party, a various form of fraud? And the answer is that we don't. It's in our data. We would see it if the servicer reports delinquency. They never give us a reason for that delinquency. If it's determined that the account was associated with fraud, then through the process the servicer would go through, that account would not only cease being reported to us, but we would get basically a letter that says that account never happened, or to remove the derogatories, and then the accounts are closed and new ones are opened for those consumers. So we don't usually get a flag because it wouldn't be closed. If it was closed, to be closed positive, we don't get an indicator of that. I know that through our fraud solutions that we work with the lenders to determine in their, in-house kind of what's happening, but we don't see it in this consumer credit file.
Thank you, Amy. And I think we had one more question that came through also. And so the comment is, it's not much real change over the last 2 quarters in spite of the new administration, Brexit, and everything going on. What do you think it'll take to see a real bump in the economy, interest rates included? Any comment?
Yeah, so I think that, at least from my perspective, I like steady as she goes. That's kind of my favorite life to live in. I think that the risks are more to the downside because there just is so much happening. We have a budget that we still have to get passed and not much time to do it in. The debt ceiling, of course, hasn't been addressed, although Mr. McConnell did say that, don't worry about it, we'll pass we'll fix it. I don't know if that's permanent or temporary, but I certainly hope he's correct on that, because we run out of money starting the 1st of October. I think 1st of October. In any event, it's coming fast, and it's not good. And the other part of it is, of course, we got North Korea getting a little agitated there, and things are a little tense. So I worry more to the downside than I do to the upside. I'd love to see things happen on an infrastructure bill. Of course, how do we pay for it? All these things are complex. But so far, as I like to say regarding Brexit, is that nothing real has happened yet. There's an announcement about the divorce, but we don't know the terms of the divorce. And until we do, we don't know how badly that's going to affect Europe and the UK. And, something of a similar shock here, nothing has happened yet. We've had no new bills passed, nothing that's truly exciting from an economic perspective. Some of that is good because change isn't always good, but we'll just wait and see.
Thank you, Amy. And that does wrap up. We are at the top of the hour at 2 o'clock Eastern, so I do want to go ahead and wrap up our call. I just want to share some additional resources as well as we're winding down. As we've shared with you in the past, we provide a number of infographics based on some of this consumer credit data that we report on. You'll also find that we will have a new infographic coming out next week on the 29th that is around the history of credit, the history of consumer credit. It's part of a new infographic and blog series that we're publishing that touches on the future of consumer credit. And finally, we have a new white paper coming out. Amy's team has published a series of studies that are available on our investor relations webpage at investor.equifax.com. The latest in this series is due out this week and focuses on recession risk. For those who attended our Q2 webinar, you may recall this being our special topic of focus last quarter. We decided to update that information and share it out as a white paper. So keep your eyes out for that information coming soon via email and through our social media channels. And we do invite you to follow us on our Equifax Business Insights blog, as well as joining the conversation on LinkedIn and Twitter. So with that, it was our pleasure to share this information with you today. And as most of you are aware, Equifax is a global information solutions company. We use unique data, assets, technology, analytics, and expertise to deliver information and create unparalleled insights through our customer-centric approach, flexible delivery methods, and scalable global platforms. On behalf of Amy, Gunnar, myself, and the entire team at Equifax, I want to thank you for your time and for joining us today. We hope you found the information worthwhile and that it provided you with the kind of insights that can help you drive more strategic business decisions. We look forward to working with you in the future, and thank you again for joining us. That does conclude today's webinar. You may now disconnect.